All right, let's dive in. We're going to tackle the world of options trading, which I know can sound super complicated, but we're going to do it by looking at just one single trade, a bet on a company called Cloudcore. And I promise, by the end of this, it's all going to click.
So let me just start with a question for you. How in the world can you get control over $20,000 of a stock for less than 500 bucks? I mean, that sounds impossible, right? Like some kind of trick, but it's not. It's the magic of something called leverage, and it's exactly what's at the heart of this Cloudcore trade we're about to break down. Okay, so let's set the scene. The whole story here is about a trader who's got this huge gut feeling. They've done all their homework on this tech company, Cloudcore, and they are just convinced that its next earnings report is going to be a blockbuster. They want to place a really big, meaningful bet on that feeling.
But, here's the problem every trader faces. Let's say Cloudcore is trading at, say, $200 a share. To buy a standard block of 100 shares, well, you do the math. That's 20 grand. Our trader, they've got the conviction for sure, but they don't have $20,000 to just drop on one single idea. So what do? How do you make a real bet without actually buying the stock?
In that question, well, that leads us right to the answer, the tool they choose. See, instead of buying those expensive shares, our trader buys something that's way cheaper and honestly way more powerful for this situation. It's called a call option. And this is the key that unlocks that whole puzzle we started with.
So what is a call option? At its heart, it gives you the right to buy a stock, but, and this is the important part, not the obligation. Think of it like putting a deposit down on a house you really want. You've locked in the price, right? So you have the choice to buy it later at that price. But if you just change your mind, what do you lose? Just the deposit, not the full crazy price of the house. That's a call option, in a nutshell.
Okay, so every one of these option contracts has a few key ingredients. You've got the stock, which in our case is Cloudcore, obviously. The option type is a call, and you use a call when you think the stock is going to go up. Then there's the strike price. That's just the preset, locked-in price you get the right to buy at. And finally, the premium. That's the upfront cost of the contract itself. It's that small deposit we were just talking about.
And this chart, man, this really just lays it all out, doesn't it? To control 100 shares of Cloudcore stock the old-fashioned way, you need to cough up 20,000 bucks. But to control the right to buy those exact same 100 shares, our trader only has to risk about $450. You see that? It's the same potential exposure, but with a tiny fraction of the capital on the line. That is leverage.
But wait, it's not quite that simple. As soon as our trader buys that contract for $450, its value starts getting pushed and pulled around by these two invisible but super powerful market forces. It's not just about where the stock price goes, it's about time and, well, hype.
All right, the first force is kind of the God guy in our story, at least for our trader. It's called Time Decay, or if you want to get fancy, Theta. The thing is, every option has an expiration date. It's like a ticking clock. And just like a ticket to a concert is totally worthless the day after the show, an option loses a tiny bit of its value every single day. It's this constant pressure working against you.
Yeah, you can really just picture a countdown timer right there on your screen, ticking away, and with every tick, it's chipping away at that premium our trader paid. So for this bet to work out, it's not enough for the stock to just move up. No, it has to move up fast enough to beat that clock.
But the second force, now this one can be your best friend. It's called volatility, or Vega. And all this really measures is how much the market expects the stock to swing around wildly in the future. So when you've got a big, uncertain event coming up like an earnings report, well, that uncertainty itself makes the option to buy the stock more valuable.
I like to call this the hype factor. As everyone gets more and more excited and anxious about Cloudcore's big announcement, the demand for these options goes through the roof. And that can actually drive up the price of our trader's contract even if the stock hasn't moved a penny yet. It's basically the market pricing in the potential for some serious fireworks.
Okay, so now we get to the main event, the moment of truth. The market has closed, Cloudcore is releasing its numbers, and our trader is just waiting. Did they make the right call?
And boom, they nailed it. The earnings report is a massive success, way better than anyone was expecting. So the next morning, when that opening bell rings, Cloudcore's stock doesn't just climb, it gaps up. It opens instantly at a much higher price.
So how does that huge jump in the stock price translate over to the options price? Well, there's another factor for that, and it's called delta. The easiest way to think about delta is like the gas pedal or the accelerator. It tells you how much your option's price is going to move for every $1 the stock moves. And with this amazing news, our trader's foot is about to slam down on that gas pedal.
So let's put some real numbers on this. The stock itself jumps 15%. I mean, that's an incredible one-day return for anyone who owned the shares, right? If you'd put in that 20 grand, you just made $3,000. Not bad at all, not bad at all.
But now, look at the option. That little $450 bet didn't go up 15%. Oh no, it exploded by 500%. That $450 premium is now worth $2,700. So why the huge difference? It's because that small, cheap premium controlled the rights to the same 100 shares. A 15% move on a $20,000 asset created this absolutely massive, outsized percentage gain on the tiny little contract that controlled it. That right there is the insane power of leverage.
So look, the really important thing to get here is that this wasn't just a blind lucky guess. Our trader followed a system, a kind of playbook that all traders use to turn a strong belief into an actual position in the market. So let's just quickly break down that framework.
It's pretty straightforward, really. First, you figure out your belief. You think Cloud Core is going to go up? Simple. Second, you choose your weapon, in this case, a call option. Third, you got to check out those forces we talked about. You know volatility is going to be high, and you know you're racing against that time decay clock. Fourth, you pull the trigger and enter the contract by paying that premium. And then fifth, the most important part, after the stock makes its big move, you get out. You exit the trade by selling your now very valuable option and taking that profit.
And what's cool is that this flexibility isn't just for making these kinds of speculative bets. I mean, traders use these same exact tools to hedge, to protect their big portfolios from a potential crash, or even to just generate a nice, steady stream of income. This whole Cloud Core trade, it's just one example of what you can do with this incredibly versatile tool.
So, we've seen how our trader used a really small amount of money to pull off a huge win. But that leaves us with one last and honestly one really crucial question. This leverage thing, it's a double-edged sword, right? We just saw what happens when it meets a winning bet. So, what do you think happens when it meets a losing one?